welcome to Understanding the Changing Tax Landscape. Our tax strategies presentation brought to you by GenCrest Capital Partners. So some of you on the call are existing clients, and some of you are just colleagues, friends, people that are interested in our firm. We welcome you all. GenCrest, until a few months ago, was Hutchinson Family Offices, which have been around for many years, founded by Steve Hutchinson. And so he retired earlier this year, and he just leaves such a legacy. We really just are continuing the work that he started with, not just to focus on investments for investments in themselves, but so much more that we do here. We really do focus on the comprehensive financial plan, on the tax planning, which we're going to be talking about today. And then also Gen Crest, so generational and thinking about a family crest. We're continuing this thought about the families, the transfer of generational wealth. And a big part of that is taxes. I mean, for most of us, taxes are our most expensive cost during the year. And so what we're going to try and do, and welcome to those who are still coming on, is talk about ways that to be aware of what you can do with your taxes now, but also strategies that you can have moving forward. We're going to be talking a little bit about philanthropic giving, gifting strategies, and the different ways that we can just try and incorporate tax planning into our overall plan and our estate plan. So welcome. I think we have a few more people that have been coming on. So if you haven't, then just make sure that you're muted for now. We are just getting started in the presentation. So here is a picture of our current team, GenCrest Capital Partners, and Amy and Sherry in the front. That's our CEO is Sherry, and Amy's our president. I'm so proud of the team that we've developed and the way that we're serving our clients. And we have several team members that are also joining us. And one is my co-presenter, Nora Fitzgerald. So I've always done this by myself, and now Nora has joined our firm. We've grown so much, and the tax work has grown so much that we added a second person for tax. Nora is our senior tax accountant, and she comes to us with a background in both accounting and also investor relations with a real estate private equity firm. She's currently working on her enrolled agent designation called the EA. So it's similar to the CPA, a lot of hard work, and it's specifically focused on tax return planning and preparation. So really excited to have Nora on board with our firm, and then also as a co-presenter today. So here's a look at our agenda. It is a lot to cover. I'm always very sensitive about people's time. So please look at this as a buffet, a smorgasbord, if you will, of tax planning concepts that we see here with the clients that we work with. And I could spend an hour on every single one of these topics easily. There are so many nuances and specifics, and you can do this, but what about this? And so what you need to realize is that we are presenting information in a general sense and trying to highlight where there may be limitations, but just know that all these are pretty complex ideas, and you have to really look at how it is involved in your own situation. This is not designed to be specific tax advice. But we're going to be covering tax return tips, talk about retirement accounts, self-employment income, required distributions, Roth conversions, gift opportunities, crypto, virtual currency, a look ahead at the tax law changes that have happened and are coming ahead, and then also BOI reporting for business owners. So do encourage you to put any questions that you may have in the chat. They'd be great. They may be questions that someone else has or someone else is thinking about. We're going to have a point. If we start getting tight on time, we'll go ahead and pivot. And if there are questions, we'll go ahead and start answering those. So for those of you who know me personally know that, yes, I am a CPA, but I also pride myself in having a personality. And so I like to incorporate a little bit fun into this tax presentation. So here we have Maxine, a classic. She's got her little eye Heart My Attitude Problem Cup, and just a great intro for us. I think this is how people think about taxes. Oh gosh, what am I going to do? She's a little worried about the new tax software. It's recommending that she slip across the border into Canada. So let's dive right in with tips for filing your 1040 return. And some of you may be aware that back in 2017, there was the Tax Cuts and Jobs Act that was enacted by then President and President-elect that did a pretty major overhaul to the way the tax return was organized, how it was calculated. And a big part of that was with the standard deduction. So we're going to be getting some more into that. But every year we typically see for a lot of these factors on the tax return, we see them indexed to inflation. So one thing I'll highlight is, and this will come up several times in the presentation, that we obviously have been in an environment of higher inflation over the past few years. So it's a good reminder that these do increase, these various components of how your tax return is calculated increase. And we're seeing them again for 2024 in areas of standard deduction, retirement plan, health savings accounts, and then going down the estate tax exclusion and the gift tax exclusion. So I kind of went through the ones that we're going to highlight in more detail in this presentation. So I want to talk a little bit to start again with the thought about the tax return. Standard deduction versus itemizing. So I mentioned the 2017 Act, and that that law changed to where personal exemptions were taken down to zero. They still technically exist, but they've been zero. And what they did instead was that they put in place a much higher standard deduction. Standard deduction being from your adjusted gross income, the amount that you then take to get to your taxable income. So what we certainly see under the current tax law is that fewer people itemize their deductions. You either itemize or take standard, whichever is higher. So especially if people are married, the married deduction for 2024 is just under $30,000 if you're under the age of 65. And if you're over 65, per person who's 65 or older, you get another $1,550 in additional deduction. So you can be looking at, around $33,000 in standard deduction for a married couple over the age of 65. And a lot of these taxpayers also, Mom, you see the cats? It's okay, it caught me out of my eye. So anyway, a lot of these people have also paid off their mortgage. So what else are we looking at that you might itemize with? They may not have mortgage interest or very small mortgage interest. Well, we want to keep in mind that our medical expenses can only be deducted at 7.5% adjusted gross income. So that's the threshold where you can start to take qualified medical deductions, which can include health insurance. It can also include some retirement home costs. It can include home health care. So it is a pretty open area. But for most people, even with the expensive dentist bills that we all seem to have these days, hard to hit that itemizing threshold when for a couple that makes $100,000, that 7.5% AGI would be $7,500. So you can't even start to itemize until you hit that threshold. Another one is taxes, what we call the SALT taxes, state and local taxes, which includes state income taxes that you pay in a particular year and your property taxes, your vehicle taxes. So interestingly, when they made this change under this 2017 Act, they kept the SALT limit at $10,000, whether you were married or single. So it really is more penalizing to married couples because they're limited to just $10,000 for combined their property taxes and their income taxes. You look at where, like I said, $33,000 of standard deduction. It's like, where are we making up the difference if we can only deduct $10,000 in our taxes, SALT taxes? We no longer have 2% miscellaneous itemized deductions. Charitable donations. So, some people are very philanthropic, and we can talk about some philanthropic strategies. One of which is that if your deductions are close to the standard deduction, if you feel like you're close and you've got a year or maybe that your income is lower, your expenses are higher, you had really high medical, you got to, that's why it's important to look at it every year, then you may want to consider bunching those deductions. And that could include with a philanthropic strategy. We have a good number of clients that use donor advised funds. And donor advised funds allow you to contribute, to take the deduction when you contribute the money into your particular donor advised fund. And then you can distribute the fund to charitable beneficiaries over time. There's actually no limit in the amount of time that you can take to make those distributions. You just want to keep in mind that you can only take the deduction when you put the money in the fund. So just good to be aware of, and that as of right now, this tax law is scheduled to expire at the end of next year. I'm certainly keeping an eye on the election, the changes with the election, with President-elect coming in. He's the one that started this original provision, and then also a Republican majority Senate. So I think it remains to be seen whether this will expire or whether they will extend it or reform it in some other way. We'll know more in the upcoming year. But as of right now, this is set to expire at the end of next year. So next, we're going to have Nora speak with us about tax credits. We're seeing more and more clients interested in these various credits, so we thought this would be a good section to add in.
Wonderful. Thanks, Ashley. Can you hear me? Am I good? Okay. All right. So there are two credits to keep in mind when filing your return. As we can see on the screen, the first one is related to home ownership. And this is for new energy efficient purchases made on your primary home, which is where you live most of the year. Making qualified improvements on your home, like energy efficient exterior doors, insulation, water heaters. These purchases can give you a credit up to $3,200 every calendar year. Wonderful. You just want to keep in mind, though, that these improvements must be made on a primary home, right? The one that you live most in. And it must be an existing home, so not a newly built home. The credit is non-refundable, but there are no lifetime dollar limits. An adjacent credit to this one revolves around investing in renewable energy for your primary home, like solar panels. You can claim a credit up to 30% of those costs on your return. And for those costs, the one that's the renewable energy, for those ones, your home can be existing or newly built. So that's a good of that one. Mm-hmm. Then you have this other credit, which has to do with clean vehicles. And essentially, you can claim a credit on vehicle purchases that are electric, hybrid, fuel cell. If you purchased a qualified vehicle in 2023 or going forward up to 2032, you can claim up to $7,500 for a new vehicle. A used vehicle that was purchased in 2023 or going forward gives you up to $4,000 in credit. There's a great website online, fueleconomy.gov. It's a handy website where you could look up a particular vehicle and see if it qualifies for either credit. But you do just want to keep an eye on your income thresholds for limitation purposes. And there's just some brands down there that kind of gives you an idea of what brands could qualify. If we head to the next slide, you can pick up some credit for vehicles that were purchased prior to 2023, but you just want to keep in mind that you can only amend up to 3 years prior to the filing date. So if you purchased a vehicle, if you're like, oh, I purchased a vehicle back in 2021 or early 2022, that would qualify, consider amending your return so that you could potentially claim up to that $7,500 credit for that purchase.
That's great. Thank you. And I think it's a good to remember also when we're talking about deductions versus credits. So just as a reminder, I was talking about we talk about different deductions. We're going to talk about self-employment deductions, the standard deduction. Those are reductions from your gross income to get to your taxable income amount. Now, these are actual credits, so they reduce the tax. So They can be very, very valuable. And also, certainly the vehicle credits for them also can be carried forward. So if you end up not using them all in 1 year, you can carry them forward for up to 5 years. So thank you, Nora. So here's the tips that I have as someone who's been filing tax returns for like 11 years now. Really have seen a shift with e-file. We certainly e-file all of the returns that we do here that we can, with rare exception. Occasionally there's a kind of return that we can't file, e-file. Gift tax returns can't be e-filed. When you have a refund due to someone, to a decedent, someone who has passed away, that also has to be paper filed with some additional paperwork. But for the most part, I really do recommend e-file. I don't really see any issues with it. I think it's more secure. I think it can be more accurate. I think it gets processed faster. You're likely to get a refund faster. So do recommend the e-file. Keep in mind that even if your taxes, even if you owe taxes and you file an extension, your taxes are due on the date of the extension, which this year is April the 15th. Sometimes it varies a little bit depending on the weekend and holidays, but it's April 15th again this year. And if for some reason you can't pay all your taxes, it's still a good idea to go ahead and file the extension, pay what you can if you can, because you're looking at a failure to pay penalty, not rather than a failure to file penalty if you don't file the extension. So do recommend extensions and trying to pay taxes on time. Making tax payments electronically. So you still certainly have the option to send in paper checks for payments, but the IRS website, and I believe everyone on this call is in North Carolina, so I'll be North Carolina specific, that North Carolina has a very good website for electronic payment submission for estimated taxes and income taxes, tax notices, same thing with the IRS. Seems very secure. We use it all the time. If you're going to make your payments electronically, you use your account and your routing. I always recommend that you verify that that payment processes and that you keep good record keeping. They always give you a confirmation you can print. You want to keep in mind changes in income, the sorts of things that I see where people run into some challenges and, maybe some surprises would be increases or decreases in existing income. A lot of times with dual income households, you may, especially if you have withholding, you're both working W-2 jobs and your W-2 is kind of in its own little funnel. And unless you communicate, to withhold more, it's really just withholding based on your income, and same for a spouse. So I'll see situations where people have been under withheld for the year or looking at starting a new Social Security income, or we'll be talking about required distributions, anything like that. It's amazing how one aspect of income can, up your marginal bracket, and then you're impacting taxes in a different way. If you have income without withholding, consider estimated tax payments made quarterly to avoid or minimize underpayment penalties. If you've had an error on a prior year return, you can always amend the return with the 1040X. There's a North Carolina form for amending also. If you are owed money, then you will get that with interest. The interest will then be taxable income, and you'll get a tax form for that for the year in which you received the refund and the interest. If you owe, then you will owe interest and penalties. And also keep in mind that there is penalty forgiveness. You can get usually every 3 years. If you have a good reason, you submit a certain form. For federal and North Carolina, there is penalty forgiveness. You at least have to pay the taxes up front. There's no forgiveness for interest. Unfortunately, tax notices happen. We see them here. I always tell our clients, certainly don't don't pay a notice. Always send me the notice. Let me review the notice. Let's make sure that it's accurate. Let's find out, why you got this notice. And so whether you prepare your own return, you're working with an accountant, I would just say I don't think the notices are very clear. I don't think that they necessarily always communicate what they're trying to communicate, and they definitely can be inaccurate sometimes. So it's always a good idea to get a tax preparer's assistance to review a notice. They can call into the tax authorities with you. Federally, we use Form 2848 for power of attorney. And finally, I'm sure that everyone is aware of this, that the IRS is still very understaffed. For me, as a tax preparer and just hearing other people interact with the tax services, it's gotten better. It was just awful during the pandemic. It has improved, but still, it is not uncommon for me to call into my specific preparer. And, if I call during kind of the busier business hours, then I might not even be able to get on to hold. And if I can get on to hold, it'll tell me, 30 minutes to an hour. So you really want to try and, again, that's why we want to do the electronic things and just make it as easy as possible to not get notices or paper file returns, amend returns. These things are sometimes necessary, but be aware that response time may be slow. And if you need to communicate with the tax authority, especially the IRS, it can be difficult to reach a real person. North Carolina is a little better. I get through to North Carolina usually pretty quickly. All right, so I'm going to touch on traditional versus Roth retirement funding primarily as a way to make sure that we're all on the same page for some of the techniques that we're going to be talking about as we go on in the presentation. So when we're talking about retirement funding, I think about buckets. So within a particular retirement vehicle, whether it be a 401k, another type of employer-sponsored retirement plan. We've got simple IRAs, which are also kind of typically for really small companies. SEP IRAs used a lot by individuals. IRAs, Roth IRAs. These are all these different retirement vehicles. And within that, pretty much now with recent tax law changes, that there's usually a Roth option. And because these accounts have been growing, and people the limits are higher, people are using them, putting more dollars away. So we really are looking at situations where people can have really significant dollars saved in these accounts by the time they retire. So we want to set the stage for some of that discussion by saying pre-tax, that's kind of what we traditionally thought of as retirement planning. Let's just keep it simple and say your employee contribution pre-tax into a 401k or a traditional IRA. You put in money pre-tax, so you get the tax deduction in the year that you contribute. It grows tax deferred in the sense that there are no taxes until you take any money out. And then it is taken as distributions are taken out of that account, it is taxed as ordinary income. And it's also subject to required distributions. So we're going to go into more detail on that later. Roth retirement funding, that is after tax. So you do not get any tax deduction on the front end, and it grows tax-free, and it's not subject to RMDs. So for both, you need earned income to fund. We're going to look at the retirement plan contribution limits for 2024. Like I said, they keep going up because of inflation. So we're really, looking at some pretty high amounts these days. For an IRA, this is really where the earned income comes in. I want to be clear that you can fund an IRA up to 100% of your earned income up to these limits. Sometimes there's some confusion around, how much can I put in? And if you're self-employed, that would be net income. So it wouldn't be just everything that came in. You might take some expenses. It's really based on your net income. So 100% of your earned income up to these limits with the catch-up contribution for 50 plus. Under the most recent tax law changes, the Secure Act 2.0, we can see on the far right that we now have a super catch-up contribution. So this is an either or. You either have the catch-up or you have the super catch-up, which is ages 60 to 63. And this gives even more opportunity for people saving in a 401k to save even more dollars. Some people have Roth options available. So again, I think about the vehicle, which is the type of plan we're talking about. And then I think about buckets, whether it's pre-tax or after tax. So it can be a little complicated or confusing, but like in a 401k for quite a while now, there has been the Roth provision where you could have a Roth in your 401k. That's not it's not a Roth IRA, it's a Roth 401k. You're not subject to the same income limits that you see with Roth IRA. And you can fund some to your Roth bucket and you can fund some to your pre-tax bucket. You're just limited in total to these contribution limits. And the Roth IRA and the traditional IRA are typically separate accounts. Okay, so beyond the scope of today, but I stress because it comes up for us, that people don't seem to have a really good handle on the limitations with the traditional IRA limits. A big one is if you have a spouse who's in a workplace retirement plan like a 401k, there are substantially lower income limits for a spouse to be able to fund an IRA. So you want to pay attention to that. So traditional IRA limits do have limits based on whether or not there's a workplace plan in place, your income filing status. For Roth IRA, it is more on your income and filing status. And the phase out for a direct Roth IRA contribution starts at 146,000 for single and 230 for joint. That's based on adjusted gross income. So here I've got another funny, but this is actually a great planning technique. And I was just speaking with a client about this yesterday. I think people are getting more familiar with this as an idea, but we can see here that dad is handing over some money to his son, and son saying, but dad, all the other kids get a Roth IRA as part of their allowance package. And this is something that you can actually do. You can give money as a parent or a grandparent, let's say, to your child or grandchild's Roth IRA. So they would need to have the Roth IRA set up in their name. And key, they need to have the earned income. So that's really where maybe that earned income limit would come in. You got someone that's working in college or something. They may not make $8,000 a year, but you think, gosh, if I can put $3,300 in my 18-year-old's account tax-free, I think it's wonderful because not only are you helping them get such a head start on their retirement savings with after-tax dollars, that's going to grow tax-free, but I think it also teaches financial accountability. There's a buy-in when you say, gosh, I've got a retirement account now. So it's really a win-win, but you want to make sure that you would pay attention to gifting limits that we're going to get to, and that they do actually have earned income. Sometimes with business owners, my mom is on the call. I worked for my parents' power tool business, filing papers and answering calls and even doing deliveries when I was a teenager, and I got Social Security, paid into Social Security, so I was a paid employee of Madden Tool and Supply. I bet you if there had been Roth opportunities back then, my parents would have taken advantage of it. So, all right. And the last thing we're going to touch on as far as our retirement accounts is health savings accounts. So you may think, well, that's not a retirement account. I think of it as a retirement account. Unlike our traditional accounts, retirement accounts and Roth, pre-tax, after tax, you're paying the tax somewhere. HSAs are great because you contribute pre-tax, it grows tax deferred, and as long as you use it for qualified medical expenses, it's tax-free, okay? Not only that, there's no required distributions, and the dollars can be invested and grow tax-free. So I don't recommend that someone put $1,000 in an HSA that they're going to likely have to turn around and use and that they invest that money. We're talking the investment strategy is more for people that want to fund the HSA with a longer term goal in mind, and to realize that they can put those dollars in pre-tax and they can grow tax-free. And it's not use it or lose it. So you can keep using it even after you no longer have the health insurance that allows you to fund it. Can pay for things like health insurance after you retire, Medicare supplements, long-term care insurance, long-term care needs, those pesky dental visits, the crowns, and all those things that add up. So I really do encourage people to kind of see a big picture about health savings accounts if you have the opportunity to fund them. You do have to have a high deductible health plan, and that is more than just a high deductible. It has to be an HSA compliant plan called an HDHP plan. So you want to make sure that your card, then they have HSA plans through Marketplace. Most companies may offer an option for it. So I'm not saying it's for everybody, but I'm saying if an HSA HDHP plan works for you and you're funding an HSA, to kind of see the big picture of what you can do with that money. You need to track your contributions, which may also include employer contributions if you're working, and report distributions. The distributions is a big one because I think sometimes people don't realize that you report the distributions And you can also report your qualified medical for that year. And as long as your qualified medical is equal to or greater than the HSA distributions, then you're not going to have any tax. But if you don't report that distribution form, then the IRS will likely send you a letter, perhaps even a year or two later, depending on their delay, and say, hey, you took this distribution, you didn't explain it, and you owe the tax. So then you're looking at having to amend your return. That probably is going to cost money. So bottom line, HSAs are great, but just like everything else, kind of have to track and understand what you're doing. And if you do take distributions, understand how they need to be reported, which does not necessarily make them taxable. And then I've got the limits down here below. So self-employment income. So self-employment income, it has really changed. It used to be, I think people either like worked for a company or they owned a business, and eventually they retired, and that was it. And now we're in this, time where people are working longer, they're working more flexible. You see people that maybe have a W-2 income, but then they have a side gig where they're, doing something, they're selling a product, or, maybe Uber driving, or, running some consulting work. We work with educators that, get paid for public speaking or teaching classes on the side, all kinds of things. So really, when we're talking about self-employment income, we're talking about any kind of earned income that would not fall under a W-2. And it isn't necessarily even you don't even necessarily get a tax form for it. So it's important to be aware of what all you need to be responsible for. So I've got a funny. I'm big into cats. I was glad to see my mom's cat made a showing on the Zoom. So, we're cat people. We got Frisky here, and his accountant is saying, Mr. Reynolds, you can't count your litter box as a deduction just because you do your business there. I know, it's so bad. It makes me laugh every time, though. So self-employment income over $400, not adjusted for inflation, interestingly. So that $400 limit, I don't even know how long it's been there, but it's been there a long time. So, I mean, that's pretty much covering pretty much anything these days. It needs to be reported on your tax return. I have in parentheses Schedule C. If you don't get a tax form at all, the Schedule C would be probably an appropriate place to report it. You may get these 1099 NEC forms. It used to be reported on a 1099 miscellaneous. We still sometimes see miscellaneous, but we see more often for self-employment income these NEC forms. They can be reported not on Schedule C, but the good thing about connecting them to Schedule C is then you can take any business deductions that we're going to talk about. I get asked all the time about setting up LLCs for liability protection. Or usually it gets brought up and they'll say, well, I want to do it because I want to save money on taxes. So a single member LLC is what's called a disregarded entity, and it's still reported on your personal tax return, typically on the Schedule C. You get your EIN, and then we can connect the EIN for that particular entity to the Schedule C. So you're picking up the income correctly, but then also able to take the deductions, but it doesn't change anything for taxes. Other types of LLCs that have more than one person in them, then you're probably looking at a separate return, more of a formal business structure. Always recommend keeping your business activities separate from personal. Being aware of hobby loss rules. This is a technical term, and especially if you are a high income earner and you are taking significant losses on a business in more than 1 year, I think you have to be really careful of showing, is there a business intent? Am I running this like a business? Because the IRS that's a big red flag for potential audit, especially with a high income earner. If you're taking big deductions, offsetting, they're going to say, is this a real business? Or is this possibly a hobby that they're trying to write off? So that can bring on IRS scrutiny. Keep in mind, again, on the Schedule C that you can deduct all kinds of business expenses. They do need to be business expenses, mileage, meals, home office expenses, way beyond the scope of what we can talk about today, just kind of getting you thinking about it. Meals are back to 50% deductible. It was at 100% during COVID. Can deduct health insurance as self-employed health insurance if you're paying your own health insurance, even including Medicare, long-term care insurance purchased through Marketplace. We've taken all of that as Schedule C, off of Schedule C income as health insurance expenses. Also, you can set up depreciation schedules on fixed assets and consider funding an IRA, a Roth IRA, or another one that we oftentimes see with high income earners that are self-employed as a SEP IRA. So now Nora is going to kind of fill us in on the latest news on the 1099-K tax form that we need to be aware of.
That's right. So similar to like a 1099 NEC, an informational form, this is what a 1099-K is. It is an informational form that is provided to you. Okay, so electronic payments are really ramping up, have been ramping up. We're talking about payment processors like PayPal, Venmo, Square, Etsy, eBay. These type of payment processors, if you hit a certain amount of payments made to you, so $5,000 or more, doesn't matter how many transactions, but if you make $5,000 or more from, say, PayPal, from being self-employed, or you do gigs on the side, or you're a freelancer, then you should receive an informational form, Form 1099-K, that will report the amount of money that was paid to you from them, from PayPal. The thing to keep in mind, though, is that the form will report the total amount of income that you received. It will not split between business related payments and personal payments. So, say you utilize Venmo. We have someone who works on our yard. So, we Venmo him money for completing the yard work. Well, he might use his Venmo to receive family or friend payments. So, keep in mind that if you do fall under this category of receiving this type of informational form, to just have good record keeping so that you are able to know, okay, I've received this much money. How do I split this up appropriately? And then remember that to keep in mind also that you would report this on your Schedule C, and to keep track of those business related expenses that would match up with this particular payment processor.
Awesome. Thank you, Nora. This is it was originally supposed to come out in 2023. And there was a lot of pushback because you think about, I mean, we all use these pay methods now. So really, like, what are they going to do? They're saying it's it's informational. I think they're just kind of testing it out, but it's going to be interesting for Nora and I as preparers, because this will be the first year that we're kind of encountering these forms and what's the best way to handle them. I think it's going to be kind of an evolving process. So have that on your radar and know that if you get it, it is just informational. So let's talk a little bit about required distributions. I know some of you on the call are probably dealing with required distributions and thinking, and others may say, I don't even know what that means. So the way I describe RMDs, we'll just call them RMDs moving forward, is we talked a lot about the pre-tax retirement accounts. And now there's so much more flexibility to use Roth, to use these after-tax dollars. But for a lot of people that are retired now, really the only option that was available to them for most of their working career was pre-tax retirement accounts. And we were told, fund, max it out. So then you end up with people that have been high income earners. They likely have income coming in from other sources that may be more tax efficient. They really don't want to have to take the IRA. Tax laws have changed, but it used to be a better asset to even pass on to beneficiaries. That has changed somewhat with recent tax law changes. But, it used to be, okay, you build up this IRA and then you can let your people inherit it, your beneficiaries inherit it, and then they can stretch it. Well, really the landscape has changed a lot with this. So bottom line, RMDs are like, you pay in, you got the tax deduction all these years, and then the government's kind of knocking at the door going, okay, time to pay up. So it used to be that it started at age 70 and a half. Then they went to age 72. They're currently at 73, and it's going to go all the way up to 75. But even if you don't need to take money out of the IRA account at these ages, you have to start taking out some amount of distribution subject to ordinary income tax. That's important because it can increase your income tax. You think about, especially someone that has a lot of money in one of these IRA accounts, that can really up your marginal bracket to where it's impacting the tax on other sources of income, like your Social Security, investment income, things like that. I mentioned the age starts at age 73. The way that it's calculated is that on day one, January 1st of every year, hypothetically, you should know what your RMD is going to be for that year because it's based on the last day of the prior year and your current age. So, for us, we're with Schwab. Whenever we go into a client's account that's an IRA, if they're taking RMDs, I can see the amount of the RMD from like very early on in the year and help them make sure that they're taking their RMDs. There is a penalty. It's gone down. It used to be 50%, 50%. Now it's 25% to not take your required distributions. And it goes down to 10% if they're taken within 2 years. There is penalty forgiveness. I have used this form several times over the years when people were well-meaning, but just for whatever reason weren't able to take a particular RMD. Oftentimes it happens in the year maybe when someone passes away and they're inheriting that IRA. There are some really specific rules around RMDs in the year of death that can be complicated. So, things happen and you can use this form to request penalty forgiveness and you want to go ahead and take it in that year. So ways to minimize taxable RMDs. Certainly you'll see that this is a trend of the presentation that I'm pretty pro Roth. And Jim, it's on this slide. I got it. QCDs. Jim's reminding me about QCDs and he comes from a background in philanthropy. So I know I'm huge into philanthropy. And so I always try to mention philanthropic giving when I can. So yes, so ways that we can minimize our taxable RMDs, consider Roth funding. If you can afford to do it while you're making retirement contributions, especially if you think that it's money that you're not necessarily going to need in retirement, money that you're identifying to pass on to heirs, Roth is a really good asset to pass on. If you're younger, if you can afford to pay the taxes out of cash flow, things like that. It's not a one size fits all. There is still a strategy available. It's a little convoluted, but it is legal. You need to understand what you're doing. You need to make sure it's done correctly. Called backdoor Roth conversions, and they were talking about making this strategy no longer allowed 2 years ago. It was kind of on the docket for tax law changes. It ended up getting squashed, so it is still available. QCDs. So these are qualified charitable distributions, and this is a wonderful way. Remember, we're talking about a lot of the people that can't itemize are people that are older, that are married, have paid off their home. They maybe are pretty serious about their philanthropic goals at that point. So it used to be the same age that you did the RMDs. So everyone thought they were kind of together. They were both 70 and a half, but they're in different parts of the tax code. So whereas the RMDs has now gone to age 72, now 73, it's going to 75. QCDs can still start at 70 and a half, where you can directly make charitable deductions from your IRA tax-free. It is not reported on the tax form that you get for the retirement account distribution. So it's very, very important that if you're doing your own return preparation, you're keeping good record keeping and you report it correctly on the return, or if you have a CPA or accountant that you're using, that you provide that information that you made the qualified charitable distribution out of your IRA. Otherwise, there's nothing on the tax form that shows it. And also, this is a strategy that we do when we can, is to consider Roth conversions in years when taxable income is low. So we'll touch on Roth conversions, and then I'm going to go about another 5 minutes, and then I'll just see if we have any questions. So if anyone else has any questions, we've got a few here, but if anyone else has any questions, feel free to pop them in the chat. Another cartoon, this one's not as funny, but I just love it. To think again, Roth IRA, I only had to pay tax on the seed. If time is on your side, Roth is a good thing. Talking about Roth conversions, that was something that we just mentioned to try and look at lowering your required distributions. As a reminder, Roth accounts, I'm talking about your own Roth, not a beneficiary Roth, have no required distributions. And also you cannot convert required distributions. So once you have to start taking those RMDs, you can't move them to Roth. You don't have to take them out, right? You can move them to a taxable account. Like we said, you can do the charitable donating, but you can't convert an RMD to a Roth. We want to keep in mind that the Roth accounts are great to pass on to heirs, tax-free, subject to this 10-year new rule about how long you can keep that account open. And what we're looking at is when we talk about Roth conversions, it's converting pre-tax IRA dollars to Roth after-tax dollars and paying the tax now. You can't undo a Roth conversion. You used to have a 6-month look back on it. And I mentioned the backdoor Roth conversion. So the key is, again, that I think about Roth conversions strategically. Usually it's something that we're looking to try and maximize in a particular year that income is low, or do a strategy of small conversions over time. Gifting. So this one goes out to my mom. I think she's still on the call. Just think, darling, one day all of this will be yours. And so I want to say my mom's house did not look like this. So this is not a reflection of her, but it is a cute reminder that there's a legacy of wealth transfer, and how do we go about doing that? And so I get a lot of questions about gifting. Just like the other inflation adjustment elements, we've seen the gifting limit really go up. I mean, we're at $18,000 per donor per donee now. So 2 parents can give their son and daughter-in-law up to $72,000 in 2024 without a gift tax return. So there's a lot of power in gifting, and it can be part of an estate strategy, estate planning strategy, estate tax strategy potentially. You can write, checks, cash gifts. You can also, we have seen people, transfer over homes. But you want to remember that if you're selling a home or selling a home to a family member or transferring a home to a family member below fair market value, to get good professional advice on how that needs to be reported. The recipient of any gift, so cash gift, it doesn't matter, but like an investment, you give them low cost basis stock, or shares in a company that you may own, or real estate, that they keep that cost basis. They keep what you bought, what your value is that you bought in for. They don't get that step up. And that's important because you do get a step up in cost basis for inherited assets. So assets that are passed at death that are outside of these IRAs, we're going to switch that off right now. Taxable investment assets, real estate, you do get a step up in cost basis to fair market value at the time of death. You have to report gifts above the annual exclusion limit on Form 709. And just looking at the lifetime gift exemption, which is integrated with the estate tax exemption, right now it's almost $14 million. If the law changes back to that pre-2018 level, it's going to go down substantially. So that's another thing that we're really keeping an eye on. Virtual currency. I get questions about cryptocurrency, virtual currency. I will talk about it from the perspective of tax, since that's this presentation. Here we have my little cartoon about bit mining. The main thing to be aware of is if you're involved in any kind of cryptocurrency or virtual currency trading, that it is very complex, and it can be not necessarily great record keeping out there. So especially if you're doing a lot of buying and selling, that you want to look at having some sort of software or a way to track your cost basis, your gains and losses. You can't, that's being tracked for you. Those transactions are reported on Schedule D. Just like short-term and long-term gains. Starting in 2025, they've created a new form. This has become so popular that there's actually now this new form, the 1099 DA, that we'll start seeing next year. Mine is that's just going to report gross proceeds. I don't know what that form is going to look like yet. So there again, it's important for you to track your basis. And sorry, I kind of went up on the slide, but that for a few years now we've had a digital asset question. So if you're doing some sort of cryptocurrency, virtual currency, digital assets, so you need to be aware that this question is on the tax return. And if you were doing any of this, selling, exchanging, gifting, receiving, that you need to answer yes to that question. So we're getting near the end. I have gone over a lot of this, and I'm happy to share you the slides. Talking about the Secure Act 2.0, a lot of these things we've kind of already been touching on. Major tax changes for next year. That's where we're just going to have our eye on, are they going to make changes? I mean, I think it'll be really widely distributed if there are things that we need to be aware of. And I'll point out here at the top of this slide, don't let the tax tail wag the dog. I think that it's important that decisions are made based on the whole financial picture and not just solely on possible tax changes or other tax changes. So I see that we had some questions. I'm going to switch over to the questions and then we'll touch BOI. Sean has a question about a pre-owned plug-in hybrid. So it looks like we can get to that later Nora, unless you have a quick answer for that. Do you know that by any chance?
Yeah, I took a look. So Sean, for pre-owned, it needs to be from a dealer.
There we go.
So
Okay.
yeah, a dealer.
Okay. Mm-hmm. And Sean, you can follow up if you have another question. Mary Ann wants to know if Hyundai, does a Kia EV apply? I would think so.
So Mary Ann, I took a look and I'm happy to send you. Oh, perfect, Sean. That's great. That's wonderful. That's a good start. Mary Ann, I did take a snip of the Kias. There are 6 that popped up, but I will say the Kia EV6, the model year 2022, that may qualify. But there are other ones, Nero, Optima, Sorento, but potentially.
So, and you said there's a good list for that. So just, yeah, good to be aware of.
6. Mm-hmm.
Jim asked, I think this is in reference to when I was talking about electronic payments for federal. Yeah, I mean, everyone's got to make their own decision, but I have seen issues with, now the IRS ironically will take a check pretty quick. They're pretty Johnny on the spot. They may take a long time to process your amended return, or, they don't pick up the phone, but man, they will cash your check. So usually not a problem, but we do use the IRS filing system very regularly for filing manual tax payments for estimated quarterly payments, extension payments, and taxes due at the end of the year. We also run payments through the tax software, which is a little bit unique, but yeah, we use North Carolina and federal, and have, you just got to be careful with putting the information in, but you get that confirmation, which is good. Okay, so can you please mention the income limits to take the electrical vehicle credit? So I think that was on an earlier slide, right? Wasn't that on
If
an
I
earlier
mention, if
slide,
not,
Nora?
I can state it out loud.
Oh, you got it?
Yeah, Liz,
Okay,
if you're thinking about new, it's so AGI, so 300,000 for married filing jointly, 225 for head of households, and 150 for all other filers. That's the income threshold for the new. The used ones, I think, are a little bit less.
okay, good.
Sure.
Neil is asking a question. When y'all are talking about payments, and Neil is talking about the 1099K from like PayPal, etc. Yeah, I think PayPal is one of them. I know for sure like Venmo and Cash App, so I would think PayPal would also be subject to this. It's any of these kind of like where you're transferring money back and forth. I don't know the answer. Are credit card reward checks taxable? I don't, I have never gotten that question.
I don't know. I'm happy to look it up, but I'd have to look it up. I'm not sure
Yeah,
offhand.
and I mean, I've certainly never seen, and I don't know if that's tied to this other question, but I've never seen anyone provide me a tax related to credit card rewards, and it would be earned income. So I would not think so. But the PayPal, I think, would fall under. I mean, this 1099K thing is going to be a big change, and it'll be interesting to see how it evolves. We've got really just 1 minute left. Anyone that needs to hop off, feel free, but I want to touch, especially for anyone on the call that has a business or, is involved in a business in some way, our beneficial ownership information reporting, and Nora's going to touch on this really quick. It's impacting a lot of people and impacting before the end of the year.
Right. So yes, beneficial ownership info. So do we just call it BOI? This was introduced at the beginning of the year, and it's really to make sure that nothing nefarious is going on. So to prevent individuals with malicious intent, no illegal operation. So it's really just kind of getting on top of that. And so what that means essentially is that if you are a business, an entity, company that officially formed with a Secretary of State, so you can be domestic or foreign company, but forms officially with the Secretary of State, you are required to report information about the entity and about owners that they call beneficial owners. And beneficial owners are basically those who have a significant ownership stake or own at least 25% of the shares, or who have a major influence or control on like the operations or equity. We can head to that next slide. Great. So this table just kind of breaks down. If this applies to you, you want to think about when you were formed. So if the entity in mind formed prior to 2024, it's a little bit easy on you. You have until the end of this year to provide your reporting about the company, about the beneficial owners that qualify, to report online on the FinCEN website. Whether you formed before 2024 or after, you do need to file electronically online. So before 2024, you have until the end of the year to file this reporting. If you formed in 2024, you have 90 days. So 90 days for that initial reporting. Whatever time you formed, if there are any changes, so like beneficial owner changes, their address legally changes their name, new driver's license, after any of those changes, you have 30 days.
30 days.
30 days. Now, the big thing right at that bottom little rectangle here is what happens if you don't do it. So 2 years imprisonment, fines up to 10K, and then you've got up to $600 per day civil penalties. So like Ashley said earlier, we're here to help provide guidance if you need any with this reporting.
Yeah, this is still navigating a lot with this. So we have a list of our known business entity owners, and if you're a client, you feel like you need to be added to that list, then please let us know. We're trying to work on getting the communication out, but you do file through the FinCEN website. My understanding, it's pretty easy. For me as a CPA, we've been told it's not covered under our liability coverage. And a lot of the accountants are taking the position that they are not going to handle this, that it's more of a legal form. So it's a little bit of a hot potato right now, but good to be aware of. And I think this pretty much wraps us up. So I want to thank everyone for being here. You're all valuable, and we hope that you've gotten good information from this presentation today. And thank you so much for your time. Yay, snaps from Barbara. Thank you, everyone.